That clean supply and demand zone on your chart may not be the real entry. It may be the trap. The best supply and demand strategy is not just a support and resistance trading strategy. It is about understanding the liquidity concept in trading, where price is reaching, who is being induced, and what liquidity must be collected before the true move begins. In this video, we build a complete supply and demand trading strategy using price action trading strategies, internal and external liquidity, inducement, market structure, and higher time frame trading strategy. You will learn how professional traders trade these zones, how to find inducement in trading, why some zones fail, and how to avoid entering too early before price reaches the real area. So, if this type of content is valuable to you, remember to like the video, subscribe to the channel, and enable notifications so you don't miss the upcoming lessons. And feel free to share in the comments which topics you would like us to explore in future videos. You will also find links to our trusted partners in the description below. Using those links helps support the channel and allows us to continue producing this kind of educational content. Let's begin with the basics. In the market, every price movement is driven by the balance between buyers and sellers. When demand is greater than supply, price moves up because buyers are willing to pay higher prices. When supply is greater than demand, price moves down because sellers are willing to accept lower prices. So what exactly are supply and demand zones on a chart? A demand zone is an area where buyers previously stepped in with strength and drove price upward. In contrast, a supply zone is where sellers entered aggressively and pushed price downward. These areas matter because the market often reacts to places where strong buying or selling occurred before. When price returns to a supply zone, sellers may become active again, increasing the probability of another move lower. Likewise, when price revisits a demand zone, buyers may re-enter the market and push price higher. In simple terms, demand zones function as potential support, while supply zones act as potential resistance. They highlight areas where price is more likely to react instead of moving randomly. However, the key is to focus on zones formed by strong, decisive buying or selling, not slow and sideways price action. High-quality zones are typically created by impulsive moves that reveal a clear imbalance between buyers and sellers. To make this more objective, we need clear criteria. For example, we can require 3 strong green momentum candles to classify an area as a demand zone. In the same way, 3 consecutive red candles with large bodies and a strong push downward can define a supply zone. The idea here is simple. We want evidence of real participation and strong interest, not just small, random fluctuations in price. Now that we understand that, the next question is how to correctly mark the supply and demand zone on the chart. Traders may use slightly different techniques, but one principle remains the same. We focus on the area where the impulsive move actually began. Identifying that starting point depends on how the candle is formed. So let us walk through a few common ways to mark these zones clearly and consistently. Here, for instance, we see the most recent impulsive move to the upside. This strong green candle is the origin of that expansion. Because the decision to push price higher happened during this candle, we mark its range as the demand zone. When price eventually comes back into this area, we anticipate some form of reaction within that zone. Another widely used approach is to mark the last red candle before the bullish expansion. This candle represents the final selling pressure before buyers took control. Once price breaks above that prior supply, the area effectively shifts into demand. So when price revisits this zone, we expect buyers to respond again, potentially leading either to a rejection or a continuation to the upside. In this specific example, the choice of candle is not critical because both candles cover nearly the same price area. However, that is not always the case. In some situations, the candlestick structure clearly determines which zone is more valid. For instance, if we mark only the first red candle as the start of the bearish move, the zone becomes very small and may not accurately represent true supply. In this case, marking the last green candle before the drop provides a broader and more meaningful supply area. On the other hand, there are situations where the first red candle offers a cleaner and more reliable supply zone. It all depends on how the move unfolds and how price behaves afterward. The structure of the expansion, and the reaction that follows will often guide you toward the better choice. Another key element to consider is the wick. In this example, the demand zone is drawn from the wick because that is where price was strongly rejected and the impulsive move actually began. The expansion did not originate from the first green candle or from the previous red candle. It started at the lowest point of the wick, which defines our demand zone. Wicks are powerful price action signals because they reveal areas where the market rejected lower or higher prices with strength. When we mark these levels properly, we increase the probability of a future reaction if price returns to that zone. With all of that in mind, here is an essential reminder. No matter how precise your supply and demand zone is, a perfect rejection from that exact level is never guaranteed. Sometimes price reverses before reaching the zone, and in other cases, it retraces deeper than expected before reacting. So the next logical question is this: how do we avoid missing trades and unnecessary stop-loss hunts? One practical way to reduce missed entries is to place your order slightly above the beginning of the demand zone, by about the size of the spread. That way, even if price only taps the very edge of the zone and quickly rejects, your buy limit can still be triggered. To reduce the risk of stop-loss hunts, you also need to adjust your stop placement according to the size of the zone. If the demand zone is small, give your stop a bit more breathing room below it. If the zone is larger, a more balanced approach is to enter closer to the middle of the zone and place your stop safely below the entire area. Now, before we move into the actual entry strategy, there is one concept that explains why these stop hunts happen so often around supply and demand zones. Many traders believe they were simply wrong about the zone, but in many cases, the problem is not the zone itself. The problem is that they entered too early, before price finished creating and collecting liquidity. And this is where inducement becomes extremely important. Inducements are specific market setups designed to tempt traders into entering positions, often in the wrong direction, so smart money can collect liquidity. In simple terms, an inducement is a trap that encourages traders to enter too early before the real move starts. Because smart money needs liquidity, they create inducements through early breakouts, fake reversals, and misleading pullbacks. They may form order blocks that appear valid, but are not the real ones. They may fill FEGs that look like perfect entries, or create equal highs and lows that seem highly tradable. Then, once enough traders are positioned, price reverses, sweeps their stops, and moves in the intended direction. Understanding inducement is important because it helps you avoid entering too early at fake levels and liquidity traps. Instead of reacting to every apparent opportunity, you learn to wait for the true point of interest. This can dramatically improve your trading accuracy and overall win rate. At its core, inducement is the process of creating liquidity before the real move takes place. It represents the final pool of liquidity engineered to fuel the intended move, and it can appear in several different forms. The most common are structural inducement, liquidity-based inducement, and time-based inducement. Let's begin with structural inducement. Among all these variations, structural inducement is arguably the most important because it occurs directly within market structure and creates patterns that traders encounter almost every day. A structural inducement happens when price generates a false structural signal, such as a fake change of characters or a misleading break of structure, encouraging traders to enter too early or position themselves in the wrong direction. Now let's move on to the second type of inducement. Before we go deeper, remember that we already have a complete video here on the channel explaining inducement in detail. In this lesson, however, we are focusing only on the part that connects directly with supply and demand trading. And for this strategy, liquidity-based inducement is the most important type to understand. It occurs when price deliberately creates a new high, a new low, or even a small order block or breaker that appears exceptionally clean, with the purpose of attracting traders into the wrong position, collecting liquidity, and then delivering the real move. And this process happens every day across all markets and all time frames. The primary objective behind this behavior is to create stop losses that smart money can later use as fuel. By encouraging retail traders to position themselves on the wrong side of the market, Their stops become a source of liquidity that can be collected before the true move begins. This is why you often see a small high form before a bearish move, a small low form before a rally, a false breakout before a reversal, or equal highs and lows swept by only a few pips. These events are not random. They are examples of liquidity being deliberately engineered before price reaches the real supply or demand area. Now let's look at another trading scenario. This is one of the most common inducement sequences in smart money concepts, and a pattern that appears on the charts every single day across multiple markets and timeframes. Imagine price is trending higher and approaching a significant supply zone. As it gets closer to that area, price action starts behaving in a very specific way. First, price breaks above a minor swing high. This apparent break of structure immediately attracts breakout buyers, trend followers, and traders using tight stop losses who believe the bullish move is continuing. Shortly after this breakout, the market forms equal highs or highs that are nearly equal. At this stage, another group of traders becomes trapped. Many retail traders interpret this formation as resistance and begin thinking, "This looks like a good place to short," before the move starts. As a result, these early sellers place their stop losses just above the equal highs, creating a clean and highly visible pool of liquidity. Before price reaches the true supply zone, the market often creates an additional inducement. It forms a small, very clean order block by pushing below and closing beneath the most recent higher low. With this single sequence, the market has already accomplished several objectives. It has swept the stop losses of breakout buyers. It has trapped traders who bought from the bullish breakout order block. And it has encouraged early sellers to position themselves based on the newly formed inducement order block. Then price quickly reverses and starts moving higher again. As the market pushes upward, it begins collecting even more liquidity. The stop losses of traders who sold from the inducement order block are triggered, along with the stop losses resting above the equal highs. At this stage, both sides of the market have been trapped. Buyers have been trapped, sellers have been trapped. Price action traders, breakout traders, and even some smart money traders have all been manipulated while price remains close to a major higher time frame supply zone. Only after creating and exploiting these inducement levels does price finally reach the true institutional supply zone, the area containing genuine institutional sell orders rather than retail traps. This is where smart money begins entering its actual short positions. From this point, the real bearish delivery starts to unfold, the move institutions intended from the very beginning. The lesson here is simple. If price creates a very clean micro setup immediately before reaching a major point of interest, there is a strong chance that setup is acting as inducement. Instead of entering on the inducement itself, wait for price to reach the real point of interest behind it. That is where the highest probability A+ trading opportunities are often found. Now let's move on to the third type of inducement, time-based inducement. Time-based inducement occurs when the market creates a trap move during periods of elevated trading activity, most commonly right before or immediately after a major session open. This form of inducement is particularly powerful because it appears consistently day after day and provides traders with some of the best opportunities to develop a structured trading plan while staying aligned with institutional order flow. At this point, you may be wondering why this type of inducement occurs so frequently. The answer lies in what happens during major session openings. Several important factors come together at the same time. Fresh liquidity enters the market. New order flow is injected into price almost instantly. Retail participation increases significantly. And smart money takes advantage of these conditions to manipulate price, create a misleading move, trap traders on the wrong side of the market, collect liquidity, and then deliver the true move that was planned from the beginning. So, now the logic becomes much clearer. A strong supply or demand zone is not only about where price reacted before, it is also about understanding whether price has already created liquidity, swept liquidity, and reached the real point of interest. With that foundation in place, we can now move into the most practical part of the video, how to actually trade these zones in a structured way. We will go through two straightforward strategies. The first one uses a single time frame, and the second combines two time frames for additional confirmation. Let us start with the single time frame supply and demand entry. This approach follows a clear and simple sequence of steps. It can be applied to any market and on any time frame. The first step is always to identify the overall market direction, because trading in alignment with the trend increases probability. So let us begin with a quick and practical way to determine that direction. When price creates a clear 1, 2, 3 pattern and then breaks out, that structure defines a trend. If price continues by breaking above the most recent swing high, it confirms continuation. As long as price remains above the latest protected swing low, the market stays in an uptrend and our bias remains bullish. If another breakout occurs to the upside, we then mark the lowest point that led to that breakout as the new protected swing low. And again, as long as price respects that level, we continue looking for buying opportunities. However, if price breaks and closes below the protected swing low, that signals a change of character. In simple terms, buyers failed to maintain control of the structure, and sellers are beginning to take over. That shift suggests a potential reversal. From that point forward, we can shift our focus to identifying fresh supply zones and preparing for possible short positions. Once direction is clear, step 2 is to mark supply or demand zones according to the rules we covered earlier. In this example, the market direction is bullish, so we focus only on demand zones and buy setups. Mark the most recent valid demand zone, place a buy limit at the beginning of that zone, and position your stop loss below it. If the stop is also below the protected swing low, that is even better, as it typically provides stronger structural protection. For take profit, aim for the next significant level in front of price. But before finalizing the trade, pause and evaluate one critical factor. How much room does price actually have before reaching the next key level on the higher time frame? For example, in this scenario, imagine we zoom out to a higher time frame and notice that price still has significant space before reaching the next major level. In that case, entering the trade makes logical sense because there is room for price to move. Now consider the opposite situation. If price has just tapped into a strong, higher time frame resistance area with clear reversal potential, taking a buy trade becomes much riskier. In that environment, it is usually wiser to wait for confirmation or shift your focus to possible selling opportunities instead of forcing a long position. So, that covers the first strategy. It is clean, straightforward, and effective, relying on a single time frame. Now let us build on that foundation and move to strategy number 2, where we combine two time frames to increase precision. On the higher time frame, we follow the exact same principles we discussed earlier. The only difference is that we refine our execution by dropping down to a lower time frame for confirmation and entry. This approach can be applied to any market and does not depend on a specific time frame. The key rule is simple. Your execution time frame should be roughly 2 steps lower than your higher time frame. Here are a few practical combinations based on trading style. For instance, if your higher time frame is the 4-hour chart, you can drop down to the 15-minute chart for execution. Now, let me walk you through how this works in practice. The first step is to identify the overall trend and mark the relevant supply and demand zones on your chart. At the same time, analyze the higher time frame structure to measure how much room price has before reaching the next key level. This helps you avoid entering trades with limited potential. Next, be patient and wait for price to retrace into your selected zone. Do not enter prematurely. The market frequently sweeps early entries and uses them as liquidity before making the real move. So the rule is simple. Let price reach your demand or supply zone first. Once price taps into the supply zone, shift to the lower time frame to look for confirmation before entering a short position. On this lower time frame, you may notice a clear uptrend, which represents the corrective move within the higher time frame structure. What we want to observe is a loss of strength inside the supply zone. In practical terms, we look for signs of rejection or evidence that the lower time frame uptrend is beginning to weaken. There are several valid triggers you can use for confirmation, such as a strong wick rejection, a break of a trend line, or even a change of character. In this particular example, however, we are looking for a liquidity grab inside the supply zone. A bearish liquidity grab happens when price briefly breaks above a previous high, but quickly returns back into the range. This tells us that buyers failed to sustain the breakout, and the move was likely a trap. At the same time, liquidity resting above the swing high has been swept. After this type of behavior, the probability often shifts toward a stronger move to the downside. In the same way, a bullish liquidity grab forms when price breaks below a previous low, but quickly moves back inside the range. This behavior shows that sellers were unable to sustain the move lower, and the market immediately rejects those lower prices. As a result, liquidity resting below the swing low is taken, and momentum begins to shift in favor of buyers. When this sweep happens inside a higher timeframe demand zone, the probability of a stronger move to the upside increases. Both bearish and bullish liquidity sweeps tend to be more reliable when they occur within higher timeframe supply or demand zones. That higher timeframe context adds weight to the setup and filters out weaker signals. So how do we execute the trade using this approach? Start by drawing a line from the tip of the wick at the most recent swing point. If price pushes beyond that level, takes the liquidity, and then closes back inside the range, that close becomes your confirmation. At that moment, you can enter the short position, place your stop loss above the swing high, and aim for the next significant level ahead of price as your target. And above all, remember that context and patience matter. Focus only on high-quality setups, control your risk carefully, and never force a trade. When you apply these principles consistently, supply and demand trading can become a structured and reliable part of your overall strategy. So traders, supply and demand trading is not about drawing random zones and hoping for a reaction. It is about understanding imbalance and structure. When you combine clear zone identification with trend alignment and disciplined risk management, you move from guessing to executing with logic. Stay patient, focus on quality setups, and let the market come to your levels to build consistency over time. So, trader, if this video helped you gain more clarity, make sure to like the video, subscribe to the channel, and turn on notifications so you do not miss the next lessons. And let me know in the comments which topics you would like us to explore in future videos. If you want to go deeper with exclusive content, early access to videos, and additional tools to support your development, consider joining the ComLucro Trader community right here on YouTube. It's a simple way to support the channel and a smart investment in your growth as a trader. You will also find links to our trusted partners in the description below. Using those links helps support the channel and allows us to keep producing this kind of educational content. Please also remember that the mission of the ComLucro channel is simple. We help traders build clarity, confidence, and structure, so every decision is made with discipline and intention. Here you will find complete courses designed as a true trading masterclass. We teach liquidity, market structure, higher time frame analysis, and supply and demand, always focused on understanding price and executing with a professional mindset. We also cover trading psychology, risk management, and long-term consistency, because trading is not just about charts. It is about mindset, discipline, and execution over time. Our main courses include Smart Money Concepts, ICT, Technical Analysis, Trading Psychology, and Wyckoff. Alongside that, we share insights from respected traders whose work helps you better understand how markets really behave. Thanks for watching, and I will see you in the next video.